Hello, welcome back to our 20th lesson. And today we are going to look at what we call business transactions in determining the net worth of a business. Now, previously we looked at the various terms used in accounting. We discussed assets, liabilities. We looked at capital, goods, services, and so forth. We looked at the various types of assets. We say we have the current assets, current assets, and fixed assets. We looked at the types of liabilities. We looked at the long-term liabilities and the current or the short-term liabilities. We looked at capital and so forth. So today, we start a new topic of business transactions. Now, here, the things we are going to look at, the contents, we are going to look at introduction, the topic. We are going to look at the effects of transactions on the balance sheet. Then we are going to see how capital changes in a business. If you have initial capital, if you have any additional investment, if you have growing and profit, how do they affect the level of capital in the business? Well, now, we start by saying business transaction refers to exchange of goods and services for money. Alright? When we have an exchange involving goods and services, we pay money, then we call that a business transaction. So for instance, if a son cultivates someone's piece of land and they are paid for it, either in terms of money or in kind, that is a business transaction. Okay? But when someone gets married and dowry is paid, that is not a business transaction. Alright? Now, there are two types of business transactions. We have cash transaction and a credit transaction. Cash transaction is a transaction where payment is made immediately goods are delivered. So immediately we dispatch goods and payment is made. This is called a cash transaction. Now, payment may either be in cash or through other forms of payment, such as checks, money orders, M-Pesa, bill of exchange, postal orders, premium bonds, and so forth. Alright? This is mean of payment. This is a form of payment. And it has to be immediate. For example, when you flag down a tuk, you tell the driver or the rider to take you to Marikiti. And once you reach there, you pay using 50 shilling or 100 shilling note. That is a cash transaction. Payment is immediate. You can go to the supermarket, do your shopping, and pay using M-Pesa. That is a cash transaction. You can come to look for tuition space for a student, then you pay using a check. That is a cash transaction. Are we together? Now, credit transactions, on the other hand, is where payment for goods and services delivered at a later date. Right? So, goods or services are rendered, they are delivered, but payment is made at a later date. That is called credit transaction. It is also known as deferred payment. You defer the payment or you postpone payment. go to the shop, get a kilogram of sugar, and you say, I'll bring money after a day or after 2 hours. That is a credit transaction because payment is not made. Now, next we want to look at the effects of transactions on the balance sheet. There are various transactions that take place, right? We want to see how they affect balance sheet. Now, a transaction taking place in a business will have the effect of increasing or decreasing some items in the balance sheet as illustrated below. Alright, so when you have any transaction in business, it can increase or decrease some items in the balance sheet, as we can see. Now, remember we talked about balance sheet being a financial document that highlights the financial position of a business as at given time. And I remember I gave you a short example of a balance sheet. Now, hopefully, in our next lesson, we're going to look at another worked out balance sheet. So, we are saying on the 2nd of July 2019, the following transactions took place in the books of Hassan Traders. So, on the 2nd of July last year, the year 2018, we are saying there are some business transactions that took place in the books or in the business of Hassan Traders. Number one, bought stock in cash for 10,000 shillings from Ali. Right? That is one transaction that took place. Bought stock in cash for 10,000 shillings from Ali. The other transaction is that received a check of 22,000 shillings from a debtor. Now let's see, what effects does these two transactions have on the balance sheet? The first one, when you buy, you say bought stock in cash, right? That is transaction number one. So, bought stock in cash for 10,000 shillings. So you have to ask yourself, those items in the balance sheet, which ones are being affected, right? Which one is increasing and which one is decreasing? So when you talk about a balance sheet, we say we have assets, we have capital, and we have liabilities. And we say a balance sheet has the following equation. A is equals to C plus L, where A is assets, C is capital, and L liabilities. So total assets should be equal to the capital and liability. So when you look at this transaction, then we have to ask ourselves, what is an asset? Which one is the capital? Which one is the liability? So here, when we say bought stock in cash, alright? When we buy stock, what happens? Stock is going to increase. So, stock, which is a current asset, okay, increases by 10,000. Stock is an asset. Which type of asset? Current asset. What has happened? It has increased. Why? Because we have bought. Then, the other effect we are having is on cash. We bought stock and paid using what? Cash. So what happens to cash? Cash has reduced. And cash is also current asset. So cash decreased by 10,000. So stock has increased by 10,000. Cash has decreased by 10,000. Those are the effects transaction above. The other transaction we have, received a check of 22,000 from a debtor. In the other transaction, received a check of 22,000 from a debtor. Alright? So, the first thing is to ask yourself, what and what are being affected? The balance sheet. We have check. Now, when you see check, when you pay or you receive a check, that money goes to the bank account. We don't have an account called check, but we have bank account. So if you receive a check, the money does not come directly to you, but it goes to your bank account. And when you pay a creditor, someone using a check, again the money goes from your bank account to their bank account. So when we receive a check, right, then what? Bank, or that is the cash in our bank, bank is our current account, goes up, increase. By what? 22,000. Then, debtor. Who is a debtor? A debtor is someone who owes you money. Maybe you sold goods to them on credit. So, this is also a current asset, not a current account. Current asset also decreases because they used to owe us. Now they have paid, so they have decreased by